Amazon, and WellPoint.
WellPoint. And by the way, if you want to know, you don't see WellPoint on the syllabus. We're going to do WellPoint on the Amex day.
You guys are all adults. So when someone
Man, you may have to defend his life.
when someone comes to us and asks us, where do we find the books and assignments for the class? The first thing that we think to ourselves is, what a fucking idiot, they're on the syllabus. Okay? They're on the syllabus! It's on the syllabus, which is on Angel. It's all there. I don't mean to be like over dramatic and use foul language, but you can do it, we believe in you. All right? These assignments are effort-based. All right? I'm trying to be like even more unsubtle than Professor Greenwald was. All right? Just give it a shot. All right? You're gonna do fine. Just leave it at that. Don't worry about your grades.
All right, I will do it without the dramatic gesture. This is the way it goes. I could not care less about your grades. If you do any kind of reasonable effort in this class, you turn in 3 one-page papers, which are even relevant to the subject, show your resume, you will get an HP. Okay, is that clear on the grading process here? If you want to get an H, if you care about that, doing a microscopic one-page paper with 50 pages of material on it is not going to help you. The H grades are going to be decided on the basis of the voluntary paper, the optional paper, and actually those grades are not going to come in until I think we agreed April. Is that clear? So all we want to make sure of is that basically you're alive and sentient and are paying some attention to the course material on these 3 one-page papers. Now, you are going to get cold call, and that is one other thing I'd like to say. If you're not going to be here, you have to email me. You don't need to give me an excuse. You just have to say you're not going to be here, because if I cold call you and you're not here, you're going to go down from an HP to a P, unless you do the optional paper. That's the only really punitive thing. But if you email me when I do my list, your name won't be on it. Now, because people seem not to have known that, and I did not get 40 to 50 emails today, which is what I normally get. And as I say, I don't need to know your grandmother died. I don't need to know any of that. As Ben said, you're adults, and if you just tell me you're not going to be here, that's fine. I will take volunteers today, but I do have volunteers if nobody volunteers. But there will be no sanction for not being here if you're volunteering. Is there anybody who would like to talk about whether they think, and this is where you always want to start, Hudson General would show up as a reasonable opportunity on a screen of ugly or obscure or boring or cheap, among other things. Is there anybody who'd like to talk about that? All right, the volunteer is Julian LeBrat here. Okay, Julian, you're going to talk about that. Thank you for volunteering. All right, next. Remember, when you do the evaluation, the first thing you've got to have an understanding is the structure of the company and what it does. Julian, do you want to talk about that too? What? The structure of the company and you're going to be reading the case for the first time? No. The structure of the company and what are the things that it does, just so we have a roadmap for when we do the valuation. Next, I need a volunteer who wants to do the valuation itself, to decide whether and what this company is worth when it was trading for $48 a share in June of 1998. Your name is? Peter. Peter, I need your last name, sorry. Lawrence. Lawrence. Oh, Peter, you were actually on the list. You were down the list, but okay. It's just so you won't ever get called on again. So, Julian, you and Peter are done. All right, what I want to do while they're sort of preparing their remarks is I want to start just by reminding you what the investment process is that we're going through here and what the value dimension of it is. So remember, you've got to find an opportunity, you've got to put a value on that opportunity. That valuation process you would hope would guide your active research efforts into an appropriate direction. And after you've done all that analysis, you've answered sort of the crucial unanswered questions, you'd be ready to manage risks. What is special about value investing as opposed to any investing that I think realistically involves all these steps is first, you're looking for cheap, ugly, obscure, and otherwise ignored. In those terms, the reason we think that works and why the statistical evidence that Tano showed you in the first class is unlikely to go away is because of, and we've talked about these individual irrationalities. Now, we haven't really talked much about the institutional irrationalities, but those are your friend too. If you are an institutional money manager, what all the evidence indicates is that once you are well established, the amount of assets you will have under management is extremely insensitive to your performance. That basically your assets grow with your average returns for mature funds. What that means in turn is that if you are risk averse, it's extremely sensitive to your performance as long as that performance doesn't deviate by a lot from the average. If you underperform by 1 or 2%, you will pretty much keep all your assets. If you underperform by 20 or 25%, you're going to get in real trouble. If you are therefore an asset management firm, how do you minimize the risk of income fluctuations and future value to your firm? And the answer is simple. You do what everybody else does. And if you do what everybody else does, whether it's closet indexing or it's just doing small variations on that, you will have a total return that's very similar to everybody else. And you will continue to get those fat fees from that portfolio. Now, I'm actually going to tell you a story about this in case you are not direct investors. The very first job I ever did in finance was helping to evaluate the AT&T pension funds in 1977. They had 200 portfolio managers. So the first thing we did, they had a lot of money, but they had 200 portfolio managers. What do you think the first thing we did was? We looked in any given week at how much of the trading was one manager selling what another manager was buying. And what fraction of the trades do you think that consisted of? Over 90%. That's exactly what you would expect. So the first thing we obviously did, and this applies to you if you decide to spread it around among managers, was that we made them submit their orders to a central facility, and we only traded the net orders, and in those days, transaction expenses were large, and there were big savings. Then we said, okay, they're doing net buying all the time. How much of the net buying is essentially just buying the market? Now, this is not looking for the beta of the net buying. It's actually looking industry by industry and sort of valuate by valuate how much of what they were doing was just mimicking the market when you added them all up together. And how much do you think that was? It's about 93% of what that collective portfolio looked like, even if the margin was buying the market. The reason that's so important is that basically what they were doing, or what you were getting from those 200 managers, was active management of 7% of your portfolio. So when you paid a 1 percentage point fee, the actual fee you were to manage 7% of that portfolio. That is a 14% fee. That is why asset managers are so rich and their investors are so poor. Because there's no way in the world that you were going to earn 14% above any market index to justify that particular fee. Now, the reason why that's important in this particular context is from the asset manager point of view. They know in their hearts of hearts that that's what they do. The average asset manager, as we talked about in the very first class, has to earn the average return on the market. That only in Lake Wobegon are they all above average. So they know that that's going on. On the other hand, they make a lovely little business taking 14% fees on active management because you don't desert them and go to an index fund at 10 basis points. How do they preserve those fees? They preserve those fees by not radically underperforming. So there is an enormous incentive for institutional managers to basically do the same thing as everybody else. So if the human instincts are driving these people to do the glamour stocks, to stay away from the ugly value stocks, to assume the stocks are going to do, they think are going to do well, are going to do well for sure, and the stocks that everybody thinks is going to do badly are going to do badly for sure. The institutional imperative of copying everybody else reinforces that to an important degree. So there used to be this large literature in the 1960s about how when managers got more professional, all of a sudden performance would improve. Ha ha. And all these value phenomena would go away. Well, it turns out that the institutional behavior just reinforced it. Second thing is that there's a lot of window dressing. What this means is, and this is again a well-documented phenomenon, that institutional money managers report their actual portfolios at the end of the year or at the end of the quarter. When they report those portfolios is when their investors look at what they're invested in. When your investors look at that, what do you want to present them with? All the stocks that did really well that everybody loves is the glamour stocks. So if you buy those before the end of the quarter, you hopefully will ignore the fact that your average performance is pretty mediocre to poor, and they'll just look at the stocks you actually hold, which are these stocks that everybody thinks are going to do really well, and they'll think, boy, this is a smart bunch of guys. And, or women, forgive me. And that is what window dressing is about, and of course, it creates an artificial demand for investment in the glamour stocks, and it produces a repressed demand for investment in the ugly, badly performing, otherwise diseased and obscure stocks. The last thing is that if you look at how institutions market themselves, and I've now been on enough panels to see this in action, very few of them can talk about their superior average performance. In fact, after fees, 70% of them or more underperform the market because, of course, on average, 50% of them outperform and 50% of them underperform. And when you subtract the fees, you obviously get a higher fraction underperform. So they don't want to talk about that. What do they want to talk about to lure investors in? They want to talk about their brilliant decisions. The stock Apple that they bought at $50 a share that is now, or $20 a share that is now $170 a share or $220 a share. They like to talk about their blockbusters, and they do. And nobody seems to bother to ask, well, what was your average performance? And again, what that will do is have them strive after stocks with these lottery ticket characteristics of very high potential returns. So far from undermining these individual irrationalities, the evidence seems to be that institutional money management imperatives actually exacerbate those behaviors. So you've got to start with something that's going to put you on the right side of the trade. Then you want to have the valuation approach, which is start with asset values, then look at earnings power values, ignore growth for the moment where all the imprecision is. We're going to talk about that later, and see what story that tells about this company. And when you do that, broadly speaking, going down the balance sheet and looking at reproduction cost of capital, if it's a viable industry, looking at sustainable earnings times 1 minus an appropriately estimated cost of capital, one of these three things is going to be true. Either you're going to have an asset value well in excess of an earnings power value. There is a story there essentially of assets not being put to work properly, assuming you've done the calculations properly. And that means that this is all about getting rid of the management that is misapplying or not taking advantage of those assets. The second possibility is this one, where there are no barriers to entry and the asset value and the earnings power value are essentially the same. If that's the case, then you've got two mutually supporting estimates of the value, and the only issue is the price substantially below those estimates of value. The final thing, which clearly involves value of growth, is where you've got an earnings power value, like in the case of Coca-Cola, well above the asset value, because there is a sustainable franchise that supports outsized returns on capital, and Tano is going to tell you what that looks like at the beginning of next week. So you've got an approach to search, you've got an approach to valuation. We're going to apply it today. First, let me just give you a little bit more of a rest, then I'll... Anybody have any questions about where we are so far? Yes?
So, just in the screening process, you know, when we look at companies that are going to have a low market quote value, is that going to eliminate, or is that going to give us a bias towards newer, younger companies? And how would we...
In fact, it tends to be exactly the opposite. Because the companies that are newer and younger, listen, if you had a new young company, when would you bring it to market? I mean, what was the period when more new young companies came to market than ever before in the history? Yes.
Tech bubble.
The peak of the internet and tech bubble. Why did people bring companies to market then? Because you got a ridiculous price for them. When do you want to bring your company to market? When markets are generally depressed and people are not attracted to new companies? Or when markets have gone nuts and they'll pay anything for anything as long as it's got the adjective new associated with it. So you've got a selection bias in when these companies come to market. And then they don't really produce much of a record, especially in the tech boom where they didn't have any profits or anything, until they fall off. So I think in general what you'll find is the newer companies, because they're selected this way, are the ones that tend to be chronically overdone. And it's the older, I mean, in a funny way, it's not new marriages that blow up spectacular and create the opportunities to get an ex-wife or an ex-husband at a good price. It's all the sort of intermediate terms ones that have gone bad, and they're out on the market with very low expectations. The same presumably applies to companies. They go out with high expectations, they destroy those expectations. Everybody is deeply disappointed. Over a period of time, the stock sells off, and that's where the markets go. All right. Are you ready? What do you want to do about Hudson General, Julie? No, just, is it a good stock to look at? You're going to be the setup guy here. You're going to be the philosopher who directs the guys who do the detailed analysis, which is going to be Peter. No, but go ahead.
Yeah, I think that it's a good company to look at because the industry is actually providing services to the aviation industry. Is not a very sexy industry, let's say, because it's not growing.
Let me ask you, is that the only thing they do?
No, there are two lines of business.
What are the two lines of business? Let's start with that.
The first line of business is providing services to aviation industry, and the other one is real estate estate development.
And where is that real estate development?
In Hawaii.
Okay. Does that tell anybody anything about this company that started? Do those really go together? So the first thing is this is a very unfocused company in a very strange collection of industries. Anything else about this company?
Actually, it's not, the company is not acting directly does business. It's other company, what they own stuff.
Okay, it's got a very peculiar structure. It's got a parent. It's got an Hudson General LLC, which runs the aviation business, and it's got Kohala, which is the Hawaiian Land Development Fund. What does the parent do? Do you have a sense of that? What is the parent do? What is the parent? Are there many assets in the parent?
No, nothing.
There's a ton of cash in the parent. Where does the parent's revenue come from?
It's come from the share they have in the company and from charging overhead fees.
Okay. So these geniuses who happen to be just good at Hawaiian land development and managing Air Force service contracts sit on a ton of cash, and they charge the subsidiary a fee to make their genius available to the subsidiary. How would you essentially then describe what the parent does? And be as cynical as you want. It sucks the blood of the subsidiary for the benefit of the brain-damaged relatives of the people who run the parent. And sits on this, so you've got a non-operating parent that actually charges people for probably non-existent services and has very substantial costs. You've got an operating business, which is an aviation service operating business, and you've got a Hawaiian land business. Does that sound like Julian is on to something, that this is the kind of mess that is well worth looking at? How many people agree with Julian? Absolutely. So the first thing is this is an ugly business. Anything else about it, Julian? Is it obscure? And here I'm going to give you a hand. On page 207, which is the selected consolidated financial data, there's a footnote there. What does that last footnote say? There are 182 shareholders of record of this company. Does that sound like it's a widely followed company? No. How many analysts do you think cover this company for the benefit of those 182 shareholders of record? None. So it definitely fits obscure. What was the market capitalization, Julian, of this company? Well, how many shares roughly outstanding are there? You can't. 1.8 million, but it's 2.1 minus whatever the 300,000 of the treasury shares. So say it's 1.8 million. What was the price that we had on this stock at the end of 1960? So roughly $50 a share. So that's roughly $90 million. Is that a big? A lot of people find it worthwhile. Do you think this is heavily traded? This is a highly liquid stock? No. So this is small. This is obscure. This is illiquid. This is ugly. But is it cheap according to the standard metrics? And that's actually where the difficulty arises. So if you look at all these dimensions If you look at that and you look at $48 a share, which is roughly where it was, it's about 101 million, but 90 million is close enough. So it's small and obscure. The dividend is $1 a year per share. Is that a high dividend yield? It's about 1%. You're not buying, I'm sorry. It's about 2% over the $48 a share. Not particularly high dividend yield. It's moderate. The earnings are $3 a share. It's trading at roughly 16 times earnings. Does that strike you as cheap? Not particularly. You convert that into an earnings return. It's sort of $3 per share over $50 a share. It's about a 6% earnings return. And if the growth creates no value because it doesn't have a franchise, what you see is what you get. That's a 6% return on this stock. The market to book, if you could look at the book value, is 1.5 for this period of time, which is pretty much at the height of the internet bubble. That's reasonably low. If you look at its performance, and I think you have the value line tear sheet, you can sort of compute how it's done over the course of fiscal year 98 or fiscal year 97. It's 13 to 17%. It's well below, by the way, the S&P return for those years. Don't forget, these are years when the S&P has done extremely poorly. As Julian pointed out, there are some good things about it, actually. It's got stable revenues. It's got no debt at all. It's got operating income. If you look at the subsidiary, that's fairly substantial, but a lot of it goes to the upstream. It's got some margins in the LLC business and a lot of long-term contracts. But if you look at the structure of the company, it is a mess. You've got the parent, you've got the operating aircraft services company, and you've got the Hawaiian land development. I'm sorry to rush you, but I'm going to try and get you out of here by 1:45, because we've run over actually by a total of 30 minutes in the first two classes. I'm going to try and give it back to you today. So Peter, you want to start to value this?
Yeah.
How do you want to proceed?
Well, so I did the asset value first.
Of what? Did you break it into its pieces, or did you do it for the whole company?
Well, I broke it into pieces.
Okay, so what piece do you want to look at first?
Well, the big thing I thought was to realize the value of the LLC.
Okay, I just want to do, you guys, so you want to do the LLC first?
Yeah.
Let's do it slightly differently. Let's do the parent first, because that's what we've got on the original balance sheet. And then let's do the LLC second, or Kohala second, or then maybe Kohala third. Is that okay?
Yeah.
All right. How do you want to value the parent? And I think you said the magic word.
So I did the asset value first.
So let's start with an asset value of the parent. Now, what are you going to take off the balance sheet of the parent here?
Well, I guess for the purposes of this numbers value of the parent, I would take off Hudson General and Hall.
Yes, so you have two items on that balance sheet. What page is the balance sheet on again? 209. So if you go to 209, you'll see two items on that balance sheet, which is investment in Hudson General LLC and investment in Kohala, which is the Hawaiian land development. We're going to value those separately, so let's ignore that and just look at what's on the parent. Okay, go ahead.
So there's the $19 million in cash. I valued at $19 million.
Right.
The $19 million in investment securities. There was a note that said that they all matured within a year and were mostly in government securities. So I valued those at book also.
Exactly. So the first thing you see is that these guys have $19 million in cash in the bank, $19 million in near cash securities. So roughly how much in total cash does it look like we've got here?
$38 million.
38 million. Keep going, Peter.
With the receivables, I couldn't find the discount that they'd taken, but I felt it was small enough that that's not really material.
Exactly.
So
Keep
I just
going.
did book.
So what was the book value?
$563,000.
Okay. And what else else did they have?
They had their advances to Hudson General, which are written in a book. Those again, I just did it.
At book?
In book, I felt they were pretty certain to get back because it's
Right, it's the LLC.
Then they had prepaid expenses and assets, and that's just 56,000.
So it's not worth. Yeah.
Anyway, and then
And that came to 2.7 million.
yeah, the land.
You add up those three, it's 2.7
Yeah,
million.
the land I also just did a book. I couldn't find any reason to do it.
Look, why don't we leave Hudson General Investment and the Kohala Investment separately? And what we've got then is we've got property, plant, and equipment. Where did that property, plant, and equipment go? It's leased to Hudson General LLC.
It's all operating equipment.
So it's all operating equipment. Are they almost certain to get that back? They've got capital leases on that. To deliver the gasoline or whatever, they've got to pay that back. Does that strike you that LLC is likely to default on that? No. So that's almost as good as cash, too. So let's include that in book. And finally, what have we got at the parent? We've got receivables from LLC at $3.1 million. When you add all that up, you get what, about $46 million?
Yeah.
Peter, how would you describe what you're buying, therefore, when you buy the company for $90 million, for Julian's $90 million?
Well, so for $90 million from the company, from the overhead, I think I'm basically getting about $46 million in cash equivalent.
Right, or very close to cash. Is that clear here? So that useless parent that does nothing has assets that are very close to what you're paying for the whole company. Now, they have some liabilities. I'm not going to make you go through them, Peter, because they're just...
I just did book.
Yeah, so we just did book value. Peter did exactly the right thing. It's about $41 million in effectively near cash that you're buying at this time. Go ahead, Peter.
I had one other thing for the corporation.
Go ahead.
Which was that there was the note about the transaction with Hudson General that said that for giving up 23% of their interest, they're receiving just under $30 million in cash. So I counted that as value at the corporate level.
Okay, okay, what Peter is saying is that they have actually, Lufthansa has actually agreed, and Lufthansa owns what fraction? Lufthansa already owns 74%. 26% of LLC. Lufthansa has exercised an option, and we're just waiting for the transaction to clear for another 23% of LLC, and they have paid roughly $30 million for that. So what Peter is saying, that's another near cash payment of another $30 million. So if you're paying $90 or $100 million for this company, what's at the parent if you include the proceeds of that transaction?
Yeah, like $71 million.
$71 million. So right away, looking at the balance sheet here before we've ever done a DCF, you should start to see that what's your net investment going to be in the remaining 51% of LLC plus the Hawaiian land. Like $29 million if you have $100 million market cap, like $19 million if you've got a $90 million market cap, which is what some of you may have because you don't have the options outstanding. Are there any questions for Peter about that? Because then I'm going to ask you one more question. What about an earnings power value for the parent?
I did do an earnings power value, and I actually, after I adjusted for the net cash back, including what they got from the company, I had them at about $40 million.
Well, what are the reported earnings, roughly, per share?
They're negative.
They're negative.
Take it on a standalone.
You take it on a standalone basis, there's no earnings power in the parent. Which do you want to concentrate on here? The earnings power of the parent or the asset power of the parent? And Peter, let me give you a rest and ask other people. case where the asset value is what you have potentially, and the earnings power is what you're stuck with the management. Now, what does that tell you almost right away before we've looked at any of the boring details of LLC about what's going to be the central issue in this investment? Peter? Can you get rid of the management? So that's the first step that Peter did. So what we've got is, and here I'm going to do it a little differently because I want to look at LLC as a whole. So you got, I'm just going to, is it okay if I just include the 41 million as a parent and count that other 30 million as part of the value of LLC?
Yeah.
Because technically it's still there. So I've got 41 million there and 74% of LLC. If I'm going to look at LLC, sorry, I did this in a different order. Let me just accommodate Peter. What are you going to start with to evaluate LLC that you're going to multiply by 74%?
Well, so what I started with was what Rafonso was paying for 23% of them. We basically multiplied to recreate the value of the whole company.
Okay. What is that called? In the language of?
The private market value.
Okay. What we have is a transaction value for LLC. If they're willing to pay $30 million for 23% of LLC, how do you get a whole value for what they're putting on LLC as a whole? You divide the 130 million by 23%, and roughly what do you get here?
So I
got somebody. If you want to,
came out to a little over 130 million.
About $130 million. We have a peon with a calculator up here. 130. So that's a good investment banker. Okay, so it's about $130 million. Is everybody happy with that value? Yes.
You could argue that's conservative because there's no change in control.
That if in fact they are paying that for 49%, and we recognize what we saw at the parent, that these assets in the hands of the parent are worth a lot less than they are run efficiently, it might be worth more than that. So there might be a control premium. Your name is Zach. Peter, do you want to respond to that?
Yeah, I thought that there was another element of conservatism there, which is that the company was basically buying with an option. So what I thought that told you was that the company was willing to pay at least $30 million for that, but it's possible that they were willing to pay more than
that. But I think that's Zach's control premium. That if things work out better. What is the argument against accepting the $130 million? What would worry you about accepting the $130 million number as a, say, long-term premium? Anybody? Yes?
I want to know what the LLC's contracts with the bonds would look like, whether they were cashing out of this or ownership.
Let me say that slightly different. When is this company being valued? What's the date here that this transaction takes place? It's the summer of 1998. What was the stock market like in the summer of 1998? Was it ridiculously high, or was it severely depressed? In fact, relative to today, where was the stock market in 1998? Substantially higher, especially if it was the NASDAQ, it was twice as high. Is it likely that those stock market valuations will affect the cost of capital that Lufthansa uses and what they will decide to pay for this company?
Yeah.
If that's the case and the market were to collapse, would we really have an asset worth $130 million? So what do we want to do next? And this is presumably your point, that they could be paying for a lot of air because that's what's going on there. And you want to look actually at the underlying assets and the underlying operating performance of this company. Your name is? Jay, do you want to do the underlying assets of the LLC? And by the way, what page is the LLC footnote on? Because you have a balance sheet for LLC under the footnotes. If you go to the footnotes after these things, you'll see there's an LLC footnote. You see that? 214, you'll see a LLC footnote. And you have a balance sheet and you have an income statement. If you work down the balance sheet, because again, we're going to be careful here. We want to do a superior valuation to everybody else. Oh, I'm going to kill myself in there. Good exercise. So at LLC, I have $3.4 million in cash. I have $16.9 in receivables. You can blow it up or not, or you can do what Peter did just to save time. I have property, plant. I have other assets of 6.4. I have property, plant, and equipment at 45.6. You can go through actually and look at what that consists of. I'm not going to spend a lot of time because you're going to see something that goes on. Say it's worth $55 million after adjustment because I probably overdepreciated a little. So I've got replacement value of the assets of the tangible assets anyway, of maybe $10 million more than the 72.9 book value. I subtract the accounts payable and other short-term liabilities, the advances and notes payable. I get total liabilities of 41.9. I basically have a reproduction value of the assets of 40 million. How does that compare to the 130? Is this a business with big barriers to entry? Is Hudson General the only one that can go after these contracts?
No.
So is it a big risk, Peter, to
Yes.
pay to put $130 million value on this?
Yes.
It is, with one exception. You have two big intangibles here. You have the long-term contracts. So even though when a contract is up, it may be competitive, I have contracts of substantial term that have value, right? That is an asset. I also have a trained labor force and organizations in place at 24 airports. And that's got to be worth something because a competitor would have to generate that. Because typically you have monopolies by an airport, or certainly for a large part of an airport. Is it going to be easy, Peter, to value those intangibles?
No.
No, it's not. So what's the other thing we can look at in lieu of those intangibles, which have to have some value? And I'm sorry, I forgot your name. Jason? Jake. Jake, what's the other thing you can obviously look at? Look at the earnings power. So here is actually Peter's private market value of about $130 million, and that's how he got it. Notice they report earnings for the LLC. You have an income statement for the LLC, right? What's suspicious about that? And again, if you go to that LLC footnote on page 107, you'll see these earnings reported. They report $14.5 million in operating earnings. They report $12.7 million in after-tax earnings. What worries you a little bit about that discrepancy? You're not paying a lot of taxes. It's a little worrisome. So why don't we start with operating earnings, Jake, and get a feel for what the earnings power of this thing is, and let's start with the $14.5 million. Is there anything you want to add to that?
Since when we look at the parent, we're basing our valuation off that side, not the earnings power of the parent. We want to add back what the parent is charging the LLC
And how do we get that number?
from the parent.
Where is the...
It's not the revenue.
It's the revenue number. The parent's revenue is coming from this tax for which they do nothing because, of course, when you're a genius at Hawaiian land development, you can't spend too much time worrying about doing deals for aircraft service because you'll ruin your real estate instincts. That's where the revenue is coming from. It's coming from the sub. So they are paying $5.5 over the LLC? No, they almost certainly wouldn't. So let's add that back. And then there probably are a lot of brain-damaged relatives of the executives of the parent driving gasoline trucks around LaGuardia and Toronto Airport that we could cut the costs on conceivably too. But let's conservatively add that back, which is 5.8. We get an adjusted earnings before interest and taxes of 20.3. Let's now tax that at 36% because we want to be careful here, which is 7.3 million. Now the net operating income after tax is 13 million. Is 130 million a decent price to pay for that? That's a 10% return. That is a good price. So even though this is in the middle of a frothy stock market, that private market value does seem to be supported by earnings. Is that right, Jake?
Yes.
So it probably is not such a bad price, and if anything, Lufthansa may be able to do better than that if they can take over the company. Are there any questions? So what are we going to value the LLC at? 130 million? If we value the LLC at 130 million, then they own 76% of that, of which, by the way, they're going to get 30 million right away, and then they're going to have 51 left that is worth half of sort of 130 million, which is about $66 million. So what is the LLC worth? Does it look like reasonably reliably is the 30 million that Peter identified in the cash they're going to get for selling that 23%. Then another 66 million in the effective earnings of 130 million, which is close to an earnings power value for the 51% they still own. So their 74% of the LLC is worth about $96 million on top of this $41 million, and it's worth that with $30 million of that effectively in cash. When you start to add that to the $41 million, effectively what you're getting is $71 million in cash plus 51% of a business worth 130 million, which is another 66. Does this stock start to look like a bargain to you? And you know as you go through this what your risks are. Do we think we made a big error in the likely residual value between Peter's private market value and Jake's earnings power value, and the notion that there really are big intangible costs to getting these things in that 66 million on the LLC? Would you be surprised if it were as low as 40 million? You would be. That 66 looks like a pretty good number. Did we make much of a mistake in the 71 million that we're getting in cash? So what's the big risk here? Peter? That we cannot get management out, sell this thing entirely to Lufthansa, and then go on and distribute the cash and results. Did anybody look at the Kohala joint venture to see if that's adding anything else? Yes?
Yeah, I just valued it at zero.
Okay?
It's losing money, but they said that the payouts will be variable because it was a land thing and development. But I figured being conservative, it's not going to be worth the negative because they could just shut it down.
Let me ask a question here. When you valued the parent, what gave you a more accurate answer? The earnings power value or the asset value? The asset value. When you valued the LLC, what gave you a better answer? The earnings power value plus the private market value, or trying to put a reproduction cost on those assets? The earnings power. That's a good example of where one is superior to the other, and you're going to look at the one you have, especially when it's supported by private market value. For Kohala and any land development company, what do you think is going to be a more reliable estimate of the value? And remember, when you value these companies, you're always trying to get a better estimate of what you're buying than the person on the other side of the trade. Is it going to be an asset value that's going to tell you more here, or is it going to be an earnings power value? It's going to be an asset value. The sales are episodic. They actually have already lost a ton of money. Are they just going to write it down? What are they likely to do if they shut this thing down? They're going to sell the land. They're going to recover what's on the balance sheet. So when we look at the Kohala footnote, which is on page what? 215. When we look at that, are we going to look at the balance sheet or the income statement? Balance sheet. So let's look at that balance sheet next. So we're going to look at the Kohala joint venture, of which we own 50%. And let's start with the non-land assets. So we've got $400,000 in cash, and then we've got the land itself in this development, which has become more valuable because they've just won an environmental case. They've got mortgages, accounts receivable, and notes receivable. And this is before. These are not subprime mortgages. They're mostly held by Japanese people who bought property in Hawaii. How do you want to value those mortgages, Peter? Book value, that's going to be close enough. It's not going to be a big adjustment. It's $2.1 million. We've got foreclosed real estate, which if the accountants are accurate ought to be close to book. People, by the way, typically tend to overwrite down or historically did foreclosed real estate. We've got other assets. Book value is roughly, you add all these up, about $6.2 million of other assets plus the land. I've got liabilities of $900,000, so I've got about $5.3 million there, and the land. Now, it is going to cost something to shut it down. You want to give me a number? Let's do $1.3 million as a shutdown cost. So the non-land part of the balance sheet should yield about $4 million. What's our share of that? 50%, so we got about $2 million there. It's not material, but it is an asset, and it's better than zero. And do you think you're going to be far off in that estimate of $2 million?
Probably conservative.
Probably conservative, but it's not going to be $8 million, that's for sure. So you've got a pretty good number there. And again, what you want to concentrate on is good, accurate measures of value. Then you've got the land. And the first question is, how much land do we have? And this is where you've got to read the Kohala narrative. And actually, if you go back to the history, you'll find out what they originally paid. So the land was originally 4,000 acres. That was what they bought. They paid $120 million for it in 1981. Or about $30 an acre. In phase 1 and phase 2, they sold 2,100 acres. That's all in that description of the Kohala land development. In phase 3, they have 550 acres, of which they've sold 26 plots, which is 130 acres. They got 420 in phase 3, and they've got 1,350 in phase 4, and actually the units are approved and they won the legal ruling. So they've got left 1,770 acres of land, the 1,350 plus the 420, and they own half of that, so they've got 885 acres. Well, first, is this a trivial cost? If it was even worth, we're now in 1998, and it's even worth what it was in 1980, how much is this roughly 900 acres worth? At $30,000 an acre. It's $27 million. This is not a trivial amount. If it were critical, and it's not because this is already a great bargain, how would you figure out the value of that land? And this is where, when you do a properly, carefully focused valuation analysis, it will tell you where to do your research. What would you do now if you decided the value of that roughly It'll cost you about $400, and he'll go out and tell you what it's worth. Remember, if this is important, get as much information as you can get from the published documents, as much background as you can get from the published documents. And went to the history of this company, you would have seen in the 1981 annual what they paid for this land. And then, if you have to collect other information, figure out the simplest way to do it, which is exactly what Peter suggested, which is take your wife and children to Hawaii, and while they're at the beach, you spend your time in the county deed offices going through transactions of which land actually traded. Or, if you don't feel that kindly about your wife and children and you don't want them to have a good time while you're catching a bad cold from the dust in that basement, what you're going to do is just go to an appraiser and get a number. When you do that, what you'll find is, which is what we found, that it's worth about $15,000 an acre at a minimum. So I've got another roughly $13 million there. I've got $2 million from the distribution. I've really got about $15 million in value. You just want to shut Kohala down. No, you're going to sell it. And there is, $15 million is not overwhelming here, but it's not trivial. It's 10% of the value that we've seen. So what I've got is, following Peter, is all the various elements of this valuation. I've got the $71 million in effective cash. I've got the $66 million in my 50% of LLC, and that's a good estimate. It's an earnings power and private market transaction-based estimate. I've got roughly $15 million in the joint venture, which gives me 71 in cash, 66 in a business, 15 million in real estate. I add it all together, it's $152 million. What am I paying for that, Julie? About $100 million. On the other hand, if I can't get that management out, and I'm left with the current earnings, and I'm not going to do this, you can make whatever assumptions you have. This is if they really clean up the organization. The earnings power might be 78 million. If they have to live with what you've got, you may at most have earnings of 110, which will give you a $13 million value, plus you might be able to get the cash out. Which of our three cases does this look like? I've got an asset which is maybe worth $152 million in asset value plus the value of the business I'm going to sell, versus maybe 13 to 50 million with the present management in place. And I can buy it for $100 million. When you make that decision, what's going to be the crucial issue? Do you want to actually buy that stock or not in this case? Yes, Peter.
Maybe see if there's like an activist who...
Exactly. You will not buy this stock unless there's a high probability that these people will get displaced. And in the 30 days before the end of 1998, the stock rose in value from roughly $33 a share to $48 a share. There's a guy called Mario Gabelli, who, if you're in the second half of this class, you'll get to listen to, suddenly managed to come up with 48% of the stock in this company. What is going to happen next, typically? Mario is going to call them and threaten them. And what's he going to say? Unless they liquidate this company, he's going to buy 4% more stock. He's going to take over the board. He's going to throw them out. That'll probably take him 3 years. And if, once he's thrown them out, they're still in the country, he's going to sue them for every penny they stole from the company on behalf of the company. And what do you think happened as a result of that? They put the company in play. And there was an auction. And this is the auction. result. Guess who decided to make the first offer? Pre-announcement, it had gotten up, by the way, to $54 a share. Management offered to buy it for $57.45, 25. Some people are completely shameless. Then Ranger Aerospace and Ogden came in. Then Lufthansa. Then management came back with $61 a share. They finally, by the way, bought it out for a value of about $160, and of course, the person who should have bought it was the person who did buy it, which is Lufthansa. All right, that is an example of what a sound valuation procedure looks like. I hope it's clear to you how different that looks from your DCF valuations, because at every stage of the game, what is you want to break it up into parts. What's the best part here? Or the best way to value this part? And what's the ultimate thing the value depends on? One last lesson. If you see this opportunity and you're a small investor, don't invest until Peter's condition is fulfilled, which is until there's some 800-pound gorilla that's going to get rid of this management. Peter, thank you. Julian, thank you. Jake, thank you. Go down and get drunk.
What number did you put on it? I saw you're not going. Okay. You were on my list. Okay, let's look at it. Okay, but you were on my list. I was checking like the guys in my list. Investment banking tax matter. Why do you need this? He gave it a class. This is like, and supposedly he wrote this entire video. The brother? Yeah. Yeah, you're going back to your apartment.
actually what finally happened that they got away with it. It wasn't strictly they filed it wasn't get it cleaned up. Yes. Sorry. recognize something we want to do. What their predecessor systems was going on in 75. And it turned out they could not. So there was no chance. They were being priced. We actually bought a lot of stock. Well-formed people thought, but it's a very powerful insurance business. People didn't see the real. They were actually bad organizations, so their potential profits were much higher than which means America could be cultural. And so a lot of employees wanted to post the companies, and we're going to do that. Magnum International, which is run by Germany, but he wasn't doing that. So that portfolio without ever really much it seemed to me that every instance, and one of the stuff that it seems to me that all disease stocks, we looked at when we thought that these diseases were sometimes a little bit wrong, so far with any of these. And it looks like it used to be better. They're still having that. Pretty sure we should solve it. So we'll see. March 1st, I guess.
Reading the report, there was many of the contracts were just running that they started running on the Canadian
Oh yeah, two of them.
and the JFK.
Right.
Do you think that was determining the tax valuation, or should have?
You could have done that, but that was, if they just started that year, you could have had that. See, normally when you bid for a contract, you're bidding in a competitive process. So the profit you make on that contract is a competitive return. So I suspect that what I'm trying to tell you is, I don't think there was any value in this contract. So it probably doesn't.
So I mean the earnings were already making.
Yeah, I mean, again, there are classic, those contracts are classic examples. Given that they had to bid on them, you think that's going to be profitable?
Depends how big it is.
I know.
After
What
10
do you
years,
expect?
from where I come from, those contracts are really valuable.
Well, that's because I mean, if it's a reasonable bidding process, then okay, so
What about the note they had with Hudson?
but that they're going to go away. See, remember what we did earnings power, especially in market to verify the returns of the earnings
If they had, for example, instead of 10 million, it was 10 million, that was
No, they're still going to go.
But the
Yeah,
illusion of the
ask yourself this. Is the LLC going to go back? And if it's not going to go back, so it's a good question. I see you.
Question about the screening process.
privates for 40 or 50 years.
Right, but why do they go public just to, if you went, no, it's not. If you have a company that you think is going to be successful, and the market is depressed, you're going to sell that company. But if the market is elevated, or this type of company is trading at a premium, and you think you're going to get 800, you're going to sell it all day long. So these are selective. They don't know. They're like new marriages. Yes.
How do you get some of those older asset values
Oh.
for a company that's an older company where you set it back?
You have original cost to the assets. On average, the company is the asset package. So, say it's 5-year average, and if capital goods prices have run flat, then that half million cost the half million cost have gone down, the production costs have gone up. You have to take buildings don't. So you don't have to.
Take the original cost of that building.
No, for take the original cost. If you've got they have to estimate
You talked about having a journal.
right, I'm going to talk, don't do that because it'll work a lot better in the context of education. Well, you took the globalization course, right? So I'm going to give that ideology along. For the globalization, and actually the lesson of people on here is becoming really smart going forward. Make terrible decisions. And want to be attractive.
That's great. So, without going into that, it sounds like it can be used for like management as well.
Oh, yeah, absolutely. Absolutely. And stock it under the commercial science.
Yeah. Great. Thanks a lot.
Okay. So you don't have to come to that session, but we're going to talk about it.
Okay, I'm gonna start that journal. It's not gonna be pretty. Thanks, Tom.
So I have another question. I didn't understand your last point. You mean for that general hospital, the company, after that you
This is a situation, if that company stays in the hands of the original management, what kind of a return are you going to get? You get the $1 a year dividend, and it's not going anyplace. They may raise it a little bit over time, but how valuable is that? It's maybe worth $25 a share. If somebody takes it over, it's worth like $70 to $80 a share. It's currently trading at $50 a share. Would you pay $50 a share unless you were pretty sure you can get rid of it? So if it's at anything above 25, and there's just no sign of the management is displaced, it's not a good place to be.
If the situation change, eventually the management change.
Right, if somebody dies or the management changes, you want to be there. But what every month, look, what's the document that tells you about the management? It's the proxy. So you're not going to, once you've done this valuation, you could look a little, you're going to look at the financial results, but what are you going to concentrate on for when you're going to put your money into this?
But actually, for most of stocks, for which company the management will change significantly, you can see the stock price rise.
Sometimes, but then it's what Tano talked about. It never rises as fast as it should. Because people are sort of still anchored to the idea of what the old management did. And they haven't done a careful evaluation of what this is what the management does. Okay?
Do you think some of the students, they apply the value index?
Some of them do.
I would say maybe 10 to 50%. And the rest of them just they give in to the irrationalities of everybody else.
Yeah, because most of investment management firms
Don't do this.
Yeah, they do fundamental analysis and
No, they don't do this. Is fundamental analysis done right. What they do is they go to China and they look at the steel company, they look at the earnings, and they project the earnings.
oh yeah.
And then they add a multiple for the growth and the fact that it's in China, and all of that's ridiculous. Okay?
And do you think your value investing strategy has some kind of limits in terms
No,
of
it should be clear it doesn't. Did you take 6301?
what's the name of it?
It's the corporate finance course,
Oh,
the
yeah.
introductory. How did you value your company in 6301? You think that is useful compared to this? If I'm valuing this company this way, and you're doing ECF, who do you think is going to be on the right side of the trade? If I'm doing it this way and I'm selling it to you, do you want to buy it from me?
Yeah, I think this theory makes sense, but a key assumption is that the market should be efficient. I don't.
You will not be right all the time, but you will be right more often than not, right? If you know what you're buying, you're going to be on the right side of the trade more often than not. And if you're careful to wait until somebody is going to get rid of this management, because that's the crucial issue, you try and find that out ahead of anybody else, that's where it's worth doing the research here. Okay?
Thank you.
I mean,
Sorry,
this
I
is
have so
about
many questions.
this is about doing well in a competitive game. And no game is more competitive than investing because you get judged against the market. And half